Hello, everyone, and welcome back. I am your host, May, and this is What Changes, the place where we decode the noise of the financial markets and try to understand the shifting tides of the global economy. Before we dive into the deep end of today's topic, I have two quick requests for you. First, if you want to be part of a community that is discussing these charts and these trends in real time, please join our Telegram channel. You will find the link right down there in the YouTube description. It is a great place to stay updated between videos. Second, I have dropped a book recommendation in the description as well, something that has really helped me frame my thinking on market cycles, so be sure to check that out. Now let's talk about the market. Have you ever looked at the news headlines in the morning and felt completely confused by what the stock market does in the afternoon? You see a headline that says, "Jobs report better than expected," or "Inflation is falling," and you naturally think, okay, this is good, the market should go up. But then you open your trading app and everything is red, the market is selling off, the charts are ugly, and you are left wondering, why? Why does the market sometimes react negatively to what looks like objectively good news? According to recent analysis, this phenomenon is not just a glitch, it is a warning. When good news fails to lift the markets, it is a signal that something under the surface is breaking. Today, we are going to break down exactly why Wall Street is rejecting these numbers, why we are entering a defensive environment, and we are going to look at three specific companies, plus a few bonus ones, that are built to win when consumer confidence disappears. One of them is a sleeper stock that you probably see every day but never thought to invest in. If you misread this moment, you won't just miss the upside. You could find yourself positioned on the wrong side of the cycle. So, settle in. We have a lot to cover. Let's start with the data. We need to understand the catalyst for this recent volatility. We recently saw a jobs report that, on the surface, looked solid. The economy added 130,000 jobs. That is a headline number that sounds positive. Furthermore, the unemployment rate dropped to 4.3%. If you look at the context of the last year, specifically throughout 2025, we haven't consistently seen these types of addition numbers, so seeing an uptick like this should theoretically be what investors are looking for. It suggests the economy is chugging along, people are getting hired, and the wheels are turning. We also have data on inflation. Inflation has come down to 2.4%, dropping from 2.7%. That is a significant move toward the targets that central banks usually look for. Even looking at the political landscape, there is optimism being projected from the top. We saw a tweet from President Trump reacting to these numbers, calling them great job numbers, far greater than expected. He noted that the United States should be paying much less on borrowing and bonds, claiming that the golden age of America is here, and predicting huge potential growth if policy is handled correctly. So, let's stack this up. Jobs added. Unemployment is down. Inflation is dropping. Political leadership claims a golden age. Yet despite all of this, the market sold off. It didn't rally. It rejected the news. The core of the issue, and the reason we are seeing this negative reaction, is credibility. Wall Street trades on headlines, yes, but more importantly, it trades on credibility. Institutional investors are looking under the hood, and what they see there is making them nervous. Let's go back to that jobs report. Yes, we added 130,000 jobs overall, but where are those jobs coming from? And more importantly, where are they disappearing? If we dig deeper into the report, we see significant losses in critical sectors. The government sector lost 42,000 jobs. Financial activities lost about 22,000 jobs. The information sector, which includes tech and media, lost about 12,000 jobs. Transportation and warehousing lost 11,000 jobs. These are not insignificant areas of the economy. These are sectors that drive stability and growth. We haven't seen losses of this nature since 2024. When the market sees the headline number go up, but sees the government, finance, and transportation sectors contracting, it creates a lack of trust. It signals that the growth might be low quality or temporary, while the structural pillars of the economy are weakening. Furthermore, there is the interpretation of the cooling data. The market is currently looking at slowing hiring and falling inflation, not as a victory, but as a sign of an economic slowdown. If hiring slows, income slows. If income slows, consumer confidence drops. If confidence drops, discretionary spending, the money people spend on non-essentials, dries up. And when spending dries up, corporate earnings compress. So Wall Street sees these good numbers as the beginning of a cooling trend that could lead to a recession rather than a soft landing. They see fragility where the headlines see strength. This leads us to a very dangerous dynamic for you and me, the retail investors. The source describes a specific pattern that happens on days like this. The market will briefly tick up on the good news. You see the green candles in the morning. It looks like a rally is starting. This lures retail investors in. They think, oh, the news is good, let me buy. But this is described as a trap. Institutional money uses that brief liquidity to sell into the rally. They are setting a trap to catch investors on the wrong side of the trade before pushing the market back down. We are warned, when you don't see markets running on good news, you know it's something to be hesitant about. We have to navigate the market based on what is actually happening, not just what the numbers say should happen. We cannot get caught up in debating whether the numbers are fake or real. We have to look at the price action, and the price action is telling us that confidence is low. So if the market is rejecting good news, what does that mean for our portfolio strategy? It means the environment has changed. We are shifting from a bullish, offensive environment to a defensive one. We can use a great sports analogy here. Offense puts up numbers, but defense wins Super Bowls. In this current market, we are trying to win the Super Bowl, which means building sustainable wealth, not just chasing quick gains. When the data doesn't lift the markets, it indicates that institutional positioning is turning defensive. Money is quietly rotating. It is rotating out of hypergrowth, out of speculative tech, and moving into assets that offer cash flow, necessity, pricing power, operational discipline. These are the companies that can survive a slowdown when confidence drops. Consumers don't stop spending entirely. They just shift where they spend. They trade down. They prioritize small comforts over big luxuries. Our goal, as investors, is to find the companies that benefit from this trade-down psychology. We want companies that provide stability as an anchor for our portfolios. Based on our research, we have 3 specific companies, and a few honorable mentions, that fit this defensive criteria perfectly. The first company on our list is a household name, Hershey, HSY. Now, why Hershey? In a high-tech world, why are we looking at a chocolate company? It comes down to recession-resistant demand. Chocolate is an affordable indulgence. When the economy gets tough, people might not buy a new car or go on an expensive vacation or buy luxury goods, but they will still buy a candy bar. It is a small comfort. Consumers trade down from luxury to these small comforts. Hershey is up 22% year to date and up 41% over the last year. That performance tells you that money is already rotating there. Here are the fundamental reasons we like Hershey right now. Pricing power. Hershey has repeatedly proven it can pass through costs. Even with cocoa inflation, they can raise prices, and people still buy the product. Brand loyalty. People don't negotiate with their chocolate cravings. If you want a Hershey bar, you buy a Hershey bar. You aren't looking for a generic substitute. Margin resilience and cash flow. They have steady operating cash flow and dividend support. In a defensive environment, you want companies with cash flow stability. You aren't looking for skyrocketing growth. You are looking for an anchor. Hershey provides that stability. It is the definition of a defensive play where the company benefits from consumers seeking comfort in tough times. The second company is in the travel sector, which might surprise you given the economic concerns. It is Southwest Airlines, LUV. The stock is up 24% year to date and a massive 73% in 1 year. Now, why Southwest? Usually, airlines are scary during a slowdown, but this plays into the trade-down psychology we just discussed. Southwest sits in a sweet spot. On one end, you have premium luxury airlines like Delta. On the other end, you have ultra-budget, low-service carriers like Spirit. Southwest sits right in the middle. It captures the float. If the economy cools and inflation stabilizes, people are still going to travel, but they are going to travel cheaper. They will trade down from the expensive carriers to Southwest. It offers a balance. You aren't paying premium prices, But you also aren't sacrificing basic service. Fundamentally, Southwest has been doing the work post-COVID. Fleet modernization. They are upgrading their planes. Fuel efficiency. This helps margins. Balance sheet repair. They have spent years getting their financials right. Domestic focus. They have less exposure to global macro volatility compared to international carriers. The logic is simple. Delta might be considered a luxury, but at the end of the day, people just want to get from point A to point B. Southwest captures that demand perfectly when consumers are tightening their belts. Now, we arrive at the third stock. This is the one we call a sleeper. This is the company that positions you for victory while everyone else is chasing hype. The company is Bluebird, BLBD. If you don't know the name, you definitely know the product. They manufacture school buses, both diesel and electric. This stock is up 19% year to date and an incredible 150% over the last 5 years. Here is why this is such a powerful defensive play. Government-backed demand. Think about it. School districts have to replace their fleets regardless of the economic cycle. It is not a choice, it is a mandate. If parents cut their personal spending, the school district still has to pick up the kids. School buses are not cyclical, they are mandated infrastructure. Bluebird has several tailwinds working in its favor. Visible backlog. They have a large order backlog, which means their revenue is predictable. Investors love predictability in a downturn. Federal subsidies. There are federal clean energy subsidies and grants supporting the adoption of electric buses. This is government money flowing directly into the company's order book. Necessity. Walk around your neighborhood. You see these buses. It is not a narrative or hype. It is contracted demand. This is quiet cash flow. It is the kind of boring, reliable business that acts as a fortress when the rest of the market is panicking over tweets and inflation reports. Beyond these three main picks, we can also look at what else is working in this defensive rotation. This gives us a broader view of where the smart money is hiding. Investors have been positioning themselves in sectors like energy and retail essentials. We see strength in companies like GE Vernova, GEV, and Advanced Energy, AEIS. Energy is often seen as a defensive haven because, much like school buses, the demand is relatively constant. There is also Caterpillar, which is an industrial bellwether, and Costco. There is an interesting note here about Walmart. Some investors who couldn't get into Costco at a good price moved into Walmart instead. This reinforces that trade-down theme again. Walmart and Costco are where people go when they need to stretch their dollars. On the flip side, we have seen some losers, specifically Goldman Sachs. This aligns with our earlier point about the financial activities sector, losing 22,000 jobs. The financial sector is struggling, so it makes sense to avoid it in favor of consumer staples and essentials. So let's bring this all together. What is the takeaway for us? The what changes community. The market is sending us a clear message. When good news, like 130,000 new jobs or lower inflation, sends the market down, it means the market is fragile. It means the big players are worried about a slowdown. We do not want to be the investors who wait for the recession headlines to appear on the news before we act. By then, it is too late. We want to position ourselves now. We want to build a portfolio that allows us to sleep at night. We don't want the pressure and anxiety of watching the market swing 5% because of a single tweet or a confusing jobs report. We want to be in Hershey for that consumer stability, Southwest for the domestic travel trade down, Bluebird for that government-guaranteed revenue. These companies represent cash flow, necessity, and resilience. We are reminded that we're only in the beginning. We got 10 more months left. It is a long game. Our dollars are our ammunition to build wealth. We need to preserve our capital so that when the cycle truly turns and the real opportunities arise, we are liquid and ready to strike, not stuck holding bags of overhyped tech stocks that crashed. To wrap up, remember the mantra: offense puts up numbers, but defense wins championships. Right now, the market is playing a nickel defense, so we have to switch up our play calling. Don't get trapped by the morning rallies. Don't blindly trust the headline numbers. Look at the sectors that are bleeding jobs, and look at where the institutional money is rotating. If you found value in this breakdown and want to keep navigating these changes with us, Please make sure you are subscribed to the channel. And don't forget my two recommendations for today. Join the Telegram channel. The link is in the description. We are building a community there that helps you navigate these tough times and put systems in place for your trading. Check out the book recommendation. It is also in the description below. My name is May, and this is What Changes. Stay disciplined, stay defensive, and I will see you in the next video.